morning, everybody. Thank you for joining us today to talk about infrastructure. I have with me Jenny Anagnos from CBRE Clarion in Philadelphia, and Jeffrey DeBlock from CBRE Caledon in Toronto. We will be talking both about the public infrastructure and private infrastructures, which are two ways of investing in the same asset class. And with CBRE Global Investors, who obviously are a leader in real assets, which is the new macro category comprising both real estate and infrastructures. Maybe Jeffrey, maybe we can start with you. Okay, today this is really a 101 on infrastructure. So I just wanted to ask you whether you can explain to us what characteristics an asset need to have to be qualified as an infrastructure.
Very good, Rogero. Thank you very much for that. One thing we've sort of evolved or seen is sort of the definition of infrastructure has been evolving. There are always sort of new sort of subsectors and themes that have been kind of captured by the ever changing definition of infrastructure. But the way we think about it is, it's always based on some pretty stable fundamentals. Some of these being that it's an essential service. That the infrastructure asset or business is critical for maintaining daily life, whether it's an electric utility, gas, water utility, whether it's a key part of the transportation, sort of key part of the transportation value chain, or parts of the digital infrastructure, whether it be data centers, fiber. Things that are just essential for us to maintain our sort of daily lives. Also within infrastructure, we're looking for tangible, long-lived assets. We're not buying brands, fads. We are buying hard assets that are, are once again essential to sort of carrying out our daily life. These businesses and assets are often very well positioned. Whether they're monopolistic or in some form of an oligopoly, those are quite critical, sort of supporting parts of the thesis. Usually there are some some pretty good barriers to entry on these assets as well, really sort of protecting the economic position of the asset and being able to generate a very predictable, stable cash flow set. Typically, you will see, some inflation protection, whether it being explicit in a contract or implicitly set. Either way, it's one of these things where the definitions of infrastructure are sort of these sort of key essential type businesses that we require to carry out our daily lives. And when you sort of put all this together, the essentialness of it, the predictability, and the economic sort of position of where we sit. Often we do notice some very high sort of EBITDA margin, cash flow margin type plays. So, in definition, those are the sort of the key points that we see are essential characteristics of infrastructure.
Great, thank you. And Jeremy, if I can ask you, can you explain to us the difference between regulated, long-term contracted and demand-based infrastructure? And in general, what is your preference? What should investors really focus on to have, let's call it a less or uncorrelated exposure to the broad equities market?
Thank you, Rogero. I am happy to cover that. I think when we talk about the different revenue profiles that you highlighted of a regulated revenue business, a contracted revenue business, and then a demand-driven, volume-sensitive revenue business, really it's captured in those sectors that Jeff just outlined. All of these, of course, essential assets with long cash flows, but different ways that they generate the revenue. And it's important to remember that there's different characteristics, of course, that each of those have in terms of their stability, their inflation protection, their ability to deliver capital gain returns in addition to the income. So first, we would definitely recommend that you need a diversified portfolio to each of these types of revenue drivers. These sectors in combination can help improve the overall risk-adjusted return profile for an investor. The regulated model typically has an inflation pass-through with some lag to it. So there's a regulatory mechanism that allows for the owners of those assets to recoup inflationary costs. So you benefit from that. In a contracted model, you might have built-in escalators, maybe not explicitly tied to inflation, but some fixed increments. And then the demand-driven ones may or may not have inflation linkage, but if inflation's rising, then they would benefit with higher GDP. So again, thinking about the benefits of all of these assets when you combine them is that they are going to diversify your exposure to different market environments that in combination are going to deliver the attractive investment attributes that people seek from the asset class.
Understood. And actually, I was looking at this presentation that you kindly shared with me, and there was this these two slides, very, very interesting, like a correlation to other asset classes of infrastructure and the performance of infrastructure assets. Okay, so if we were to comment on this slides, what would be the key message for an investor as to why they should invest in infrastructure? And since you have helpfully segregated the listed and the private, we can actually touch on this aspect of why public and why or private.
Yeah, I'll make some comments on the listed market and infrastructure broadly correlating to other assets, and I'm sure Jeff would have some additional comments. The underlying nature of the assets and the cash flows that were described generally means that they're not economically sensitive. They don't relate to a cycle because of their essential part of our activities, and so the underlying cash flows are certainly more resilient during economic periods of volatility. You certainly saw that last year during the pandemic, as we've seen in other cycles in the past. The listed market for infrastructure is part of the equity market, and so we do participate in the daily valuation of our assets, and we also participate in the flows of capital that kind of come in or out of the just broad equity market. And so while the asset performance was very stable last year, the overall equity market was quite volatile, and that did impact listed infrastructure. So in shorter periods of time, you are going to find a higher correlation to equities in the listed market. But one of the benefits it has, of course, is the liquidity and ability to tactically reposition portfolios when those volatile periods occur, so that we can take advantage of mispricing of infrastructure assets in short environments where it's more difficult to execute tactical repositioning in a private infrastructure portfolio. So the example would be last year, we did significantly reduce our exposure to those volume sensitive GDP assets, which were the most under pressure during COVID. And of course, yes, and then added to things like communications where the cash flow is more resilient. So there's a benefit during those periods. You do have that more high correlation to equities, but for an active manager can benefit. Jeff, you probably have better insights on the private market correlations.
For sure. Thank you, Jeremy. Thank you, Rogero. As far as the private markets of infrastructure, I think it's easy to see there is less correlation than many other sectors. Once again, the overlying main point here is that the cash flows of infrastructure businesses are typically unrelated to that of the broader cycle. And when we are in the private space, you're not quoted necessarily on a daily basis. You tend to sort of mute out the exuberance towards the upside and also to the downside. And instead, when we run our valuations, it's more intrinsically driven. What are the underlying cash flows of the business expected to be? Because once again, the fundamental point here is that these are predictable, known cash flows of essential services backed by hard assets. So when we do the valuation, it's primarily being done off of an intrinsic cash flow based model that we update on a quarterly basis. We do also sanity check and reasonableness check versus where the public market comps are to make sure that we get capture flavors of market sentiment. And also, be cognizant of where comparable assets are trading. Whether it's other things that we're buying or selling, or our peers are. It's good to have that sort of that flavor captured in these valuations as well. So that's kind of the method for which we do our valuation process. There is a high degree of independence brought into our valuation process. And I think those sort of outputs of the valuation is kind of captured here in the slide of how we typically observe the correlation between other sectors within the broader market.
So in other words, if we were to create a portfolio which includes both listed and private infrastructures, okay, and consider that as a single security in our portfolio, we would be we would be considerably reducing the correlation to the global equities market whilst maintaining the exposure to the sector. So that would be the benefit of having public-private together in the same portfolio without losing too much liquidity.
That's exactly right.
And moving to the performance, we in this other slide we have a listed infrastructure and private infrastructure tracked set. Do these sectors generate, if you want, alpha relative to the other asset classes?
Yes, I'll start and Jeremy can fill in. Yes, we've as you sort of go through that I'll start on the unlisted side. I think what you see here is a steady performance. You can see the returns, sort of in the sort of high single digit, low teen type returns is what we project for our fund. And what others have sort of seen and experienced in the sector more broadly. So I think as a sector, the private space has generated alpha throughout the years and also delivered it in a fairly predictable and steady way.
Yeah, and for listed infrastructure, you can see that the orange boxes over this 10-year time period, typically well pacing along with private infrastructure. There is more volatility in the return stream, again, due to that equity linkage. But general returns, when you average them out over the long term, are going to show up, very much comparable to private infrastructure returns.
Understood. And of course, these are averages. We are not specifically commenting on the performance of your strategy. I mean, actually, this one stops at 2019. I attended, Jeff, your recent webinar, and it's clearly off chart the performance of your fund. I'm now going to flip back to this page 4, talking a little bit, I mean, drilling down a little bit more on the details. What are we really talking about? Okay, when we talk about infrastructure, one question that clearly comes to mind is the difference between social and economic infrastructure. This seems to be now an investment universe. I mean, especially the social infrastructure tends to overlap also with the real estate. So why don't you put a little bit in context, Jeff, the difference between social and economic infrastructure, and take us through some example of what an investor might come across.
Very good, thank you. This is, as far as categorizing infrastructure into groups, social and economic are sort of two broad brush buckets that infrastructure can be categorized in. Social infrastructure is typically being viewed as carrying out an extension of often government, municipal, state, federal type programs that that need essential assets to be built. Many governments around the world are often cash strapped to fund major capital projects that are often quite large and spread out over many years. And often is not in their core competencies of delivering these types of large projects. So typically what they do is these governments will often seek is input from the private community to assist with the build out, whether these be schools, healthcare, judicial, public transport type programs, to sort of assist with building that, often in exchange for an availability payment or else a payment that does have some sort of volumetric ties to it. So that's kind of the broader brush picture of what social infrastructure is. I think you've seen many of these projects often called public-private partnerships, or P3s. That is typically the funding model, the economic model that these are categorized in. And then I think we kind of broadly categorize most of the other sectors as economic infrastructures, where these are sort of private market solutions, whether they be, in the transport space, in the utilities, in the energy or digital infrastructure. And with those, per our earlier point, you can often see many sort of different revenue models, and that's where we can get into some long-term nominally priced contracted assets, long-term inflation-linked protection, regulation, or just straight up sort of volumetric, like a fee-for-service type play. So that's kind of the broad buckets to kind of generally categorize infrastructure in.
Understood. And there was one category of infrastructure which was sometimes mentioned, which is called a fake infrastructure. Can you explain what people mean for fake infrastructure?
Fake infrastructure is I think be a few things to different people, but it's typically we've also sort of called it infrastructure like, or sort of items that sort of push the boundaries of what infrastructure is. I think it could be a good business or a good asset that's trying to act like infrastructure without sort of having those key fundamental points that we really do look for when we're making our investments. So we've seen sort of many examples where people are, I think, excessively pushing the boundaries, but for us, I think we pretty much stick true to our knitting of delivering on kind of core plus type infrastructure, and that's one where we avoid the sort of the fake infrastructure, or the the infrastructure like, or just sort of wherever you sort of see the market moving to, I think irrationally these days.
Yeah, we heard things like tourist infrastructure and try to fit into the portfolios. Good. And Jeremy, one last question before we wrap up this this chat. What are the risks of investing in infrastructure? I mean, what do you normally look at on the negative side?
Yeah, I think you have to appreciate noting that one of the main revenue drivers that we talk about is regulated assets, that there is a regulatory risk profile to a number of the types of infrastructure assets we would look at. And so when policies change and people dictate policy, government and society changes, that can alter regulatory outcomes. And so you have to be mindful of those changes. The other risk related to that and impacts all infrastructure assets is, when the required returns change due to changes in the allowed returns from, a weighted average cost of capital determination. In fact, many infrastructure assets on the regulated side have been dealing with declining allowed returns as we've been in a declining interest rate environment. Perversely, the misnomer on infrastructure is that rising interest rates will impact the asset class in a negative way, when certainly for rising interest rates for regulated assets, the allowed returns increase. So for the same asset, you will be allowed a higher return. So that does have actually, positive benefits. I think we do think about, the level of finance costs, though, because interest costs, and these are typically, heavily financed investments. So you have to be mindful of the amount of debt and the duration of that debt and its interest structure. So again, many assets tend to have a fixed interest cost terms. So again, rising interest rates may not immediately impact the cash flows of the assets, but you have to think about that as a future risk if we enter into a very high interest rate environment. So those are two key risks that we think about for the assets and could impact both near and long-term return outlooks.
Understood. And Jeff, staying on this subject, on the private side, obviously interest rates form part of the discount rate that you use to value your assets. If we were to enter into a period of let's say hyperinflation, which would force the regulators, the central banks, to hike interest rates, what would be the impact on the valuation of your portfolio?
Sure, I think, if one does believe there could be hyperinflation coming, which I think is a bit of an outside view, but I think it could affect or impact private infrastructure assets in a few ways. But I think at the end of the day, these assets and businesses, I think, should outperform and stand the test of time. And once again, when you build a proper portfolio that hedges and takes into consideration these risks, I think you still do set yourself up quite well to make it through and endure, just as we did quite well, and many of sort of our peers have as well, during the COVID crisis. So I think what we typically see or could see in a period of higher inflation, would be that interest rates, would move up. That would affect the cost of debt, also the discount rate. But I think, if you are in one of those higher inflationary periods, often you see it tied to some sort of economic growth. So many of the businesses that do have, some of those that do kind of capture some of that growth, explicitly or implicitly, would see the benefit. To the extent there are some explicit inflationary protections inside the contracts, that would be captured on the revenue side. Many of our businesses also have cost pass-throughs where, as should costs ratchet up in this higher inflationary period, that would be mitigated. And then sort of lastly, as some contracts reset, you'd be able to kind of capture and roll into those new economic realities. So I think in summary, this is part of building a thoughtful portfolio and the process that we undertake when we build our private infrastructure portfolios.
Understood. Very good. Okay, so we have reached the end of this chat. Okay, so thank you very much, Jeremy. Thank you very much, Jeff, and see you next time.
Thank you.
Bye-bye.